Howdy, Jacob here. Today we're looking at Old Dominion Freight Line, Company 91 of our high ROIC screener. Ground transportation looks like they operate less than truckload motor carrier in the United States and North America. I'm sure you've seen them if you've ever done a road trip. 47 billion market cap on a little bit less enterprise value, so good to see net debt is negative in the fact they have more cash on hand than debt. Growth has actually over doubled over the last 9 years, but is down due to the fact that post COVID there was a very wild increase in ground transportation, which makes sense. But crazy to see operating margins are actually greater this year than what they gross margin was in 2014. So very impressive there. Have paid a dividend since 2017, and that dividend looks to be a very inconsequential amount compared to their earnings per share. Return on invested capital has been very substantial in the 30.6% in 2023. The balance sheet shows 434 million cash on hand with just 80 million short-term and long-term debt. Very safe balance sheet, no concern there. Free cash flow shows capital expenditures over doubling, but cash from operations, 300+% increases. So big increase there. So you can see a little bit of reinvestment back in themselves, quite a bit of share repurchases, which does inflate their ROIC. And then the dividend is currently paying out probably 25% of their 5-year average free cash. It's very low. So no concern there. And yeah, I think we're ready to start making some assumptions on this puppy. So revenue growth, let's say, I think they're going to grow a little bit more than inflation. Let's do 5%. Let's put a slight premium on them. It does cost a lot to keep it going, it looks like, from a capital expenditure standpoint. So I'm not going to have too high of a premium given the fact that at the end of 7 years, their growth will probably be closer to inflation, closer to the market average. I'm just putting that slight premium above the 15 average that I've seen in history due to the fact that they have possibilities of returning pretty excess ROIC, pretty good return on the investment back in the business. So let's do some margins here. It looks like earnings are quite a bit higher than free cash flow, which I don't necessarily enjoy. But let's do maybe 16, 14. Let's say they buy back 2% of shares. You're looking at about 900 million. That might be quite a bit. Let's do 1.5% of shares. You're down to like 700 million. I think that's a bit more reasonable. Their dividend is only 20% or so. Let's increase that with their revenue growth, saying that they'll pay out at the end of the 7 years will hopefully be relatively in line to that 20, 30, 35% or so. So nothing substantial. They still have ability to reinvest back into themselves, and they definitely need it due to the fact that capital expenditures on this business and the industry are fairly high. So right now it just gets to a price that's a little bit attractive, a little bit expensive. Sorry. I would say that it does look like a good business. A couple things. I don't like that free cash flow margin is lower than earnings margin. I don't like that the capital expenditures are pretty expansive in comparison to cash from operations. Obviously, they are producing pretty hefty free cash flow. Still, in the low double digits is still very impressive for this industry and business, but I'm still a little bit concerned by the fact that the capital expenditures are it just takes a lot to run the business. It's not like software stuff where it's cash free, but again, you can find an absolutely great buy and a great investment in these types of businesses. But right now, I just think it looks a bit expensive. So hopefully you enjoy the video and have a great rest of your day. Thank you.